Hey, it's Jim, and this is Level 1 of the CFA program, the topic on financial statement analysis, and the learning module on an introduction to financial statement modeling. The good news for you guys is that we are finally at the end of this topic. Seems like we've done 100 of these learning modules. This is the last one. But the bad news for you guys is that what we're going to do is we're going to take everything that we learned about the income statement and the balance sheet and the statement of cash flows, and we're going to apply it to financial statement modeling. What that means is that we're going to use some history lessons to try to estimate the future. You'll see that here in these learning outcome statements. I'm guessing you guys have noticed that this learning module it exceeds 50 pages, and there are tens of pages of financial statements. Our slide deck here is over 70, so this is going to be a long slide deck. I'm hoping that I can get through it in a reasonable amount of time. But we'll spend about half the time today on that very first LOS. Then we'll finish up with some competitive position and Porter's 5 forces, which shows up in the CFA program every now and again. But notice that fourth LOS, we're going to forecast company sales and costs. We're going to worry about inflation and deflation, and then we're going to do some long-term forecasting. But I want to point you to that second LOS. Clearly, the Institute is integrating some of its topics. You know, it used to be there was a study session on behavioral finance, which kind of stood all by itself. But what the Institute has done, and I think this is fantastic, is it has taken these behavioral issues and it has thrown them into different topic areas. So we'll talk about a few behavioral issues inside of this learning module. So let's start with this sales-based pro forma company model. Notice that first arrow point, predicted future sales. This is what we're going to start with. We're going to start with the top of the income statement, work our way all the way down to the bottom, which means we need to figure out P times Q, right? Price times quantity. Then we need to figure out the expenses, and we'll see we've got a bunch of different expenses. We've got the regular old general, selling, and administrative expenses, and we've got operating expenses. We have interest expenses. We've got depreciation expenses. So you'll see all that on a slide. But here's a great exam question about a motivation. So I can envision the Institute saying something like, hey, here's a company. Why is it doing this? And well, there's the answer right in the middle. This pro forma model is going to help us with capital budgeting. It's going to help us with financial planning. It's going to help us with our strategic planning from an operational standpoint. We're going to use this to swing back to these earlier learning modules here under this topic to reevaluate our financial statement analysis and what happens when corporations issue bonds and issue shares of stock. How can we use this model to help us value the bonds and the shares of stock? Of course, the common tool is Excel. We're not going to get out the Excel spreadsheet here, although some of these slides were produced with Excel. But I'm guessing that someday the Institute will move to testing using Excel. My students, they always say, Jim, why do I have to use a financial calculator? I can use Excel. And for my upper level classes, I say, have at it. So what we're going to do now is we're going to look at this Diego Holdings, UK-based company. And this is going to take us through the next 25 or 30 slides. 2 main business segments, spirits and liqueurs. What does that tell us? 78 and 88% of operating profit, which means that beer and wine has to do the other 22 or 12%. Look down at the bottom. We're going to construct pro forma income statement, cash flow statement, and balance sheet. Now, what I don't want you to do, and of course I'm guessing that those of you who've looked at this learning module will know that there are tens of pages of financial statements. We're going to have tens of slides, maybe not that many, inside of this slide deck with financial statements and pro forma and revenues and operating expenses. But I don't want you to get bogged down with all of these numbers. Clearly, the Institute can't give you 27 pages of financial data and say, oh, compute the operating profit margin. What it will do, just from a testing standpoint, is it will give you pieces and parts of tables. And you won't have to be responsible to compute every number that shows up in these tables. Although if you read the learning module, the Institute does a great job of telling you where each of these numbers originates. But here's the thing, if you look at the end of this learning module, the questions are focused on just a handful of areas. This is the primary one. So notice that in 2022, we've got the 2 segments for revenues, the 2 segments for operating profit. So I encourage you to get out your calculator and do the 462 divided by the 1650 over on the right-hand column. You ought to get the 28%, and then do the same thing for beer and wine, 13.4%. So what I'm going to encourage you to do is pause the video regularly, get out your calculator, and make sure that you can compute some of the ratios that I'm going to suggest are most important. Now you'll learn this. This is really not my opinion, but you'll learn this when you go to the end of the learning module and you'll look at those 22 questions, and there are maybe 5 or 6, only 5 or 6 that relate to this first LOS. So I want you to make sure that you can do those 5 or 6. So that's what you get here on this first slide. Current operating profit margin. Make sure you know how to do that. Clearly the math is obvious here from this table. Here's some advice on what we're going to do. We're going to forecast revenue. We're going to forecast expenses from an operations standpoint. We're going to keep moving down the income statement and forecast earnings before interest and taxes. And then we're going to look at the expenses that do not relate to our operations. And that, of course, is interest expense, income tax expense. And then we need to worry about whether the company has warrants or options out there. We need to forecast the outstanding shares. So in general, each one of these, if we compartmentalize them, they're going to be relatively easy. But I don't want you to get overwhelmed with the magnitude of the learning module and the magnitude of this slide deck. All right, so how do we estimate revenue growth and future revenue for the company? Well, let's just go back to our microeconomics learning module. We have a P and we have a Q. We're going to take the price times the quantity. So look down for each segment. Revenue is influenced by volume and pricing. So there are the supply and demand conditions that are appropriate for, and let me just go back here. Think of what's the supply and demand for spirits and liqueurs. What's the supply and demand for beer and wine? You know, these are, even though it's alcohol, right? These, and this is what I have learned from being married to a woman who is a wine connoisseur, or at least she thinks she's a lower level wine connoisseur. She's of the $11.99 a bottle kind of a connoisseur. But even at that level, she says, you know what? I'm interested in wine, but I'm not that interested in vodka or gin. So these are two, even though these it's the same firm, it's alcohol, these are two separate segments. And by the way, the learning module has different alcohol example in there as well. So volume and pricing, we're going to worry about foreign currency estimates. Remember that there's an entire section, there's an entire learning module on foreign currency and purchasing power parity and interest rate parity and the rates of inflation and why do some currencies increase in value and decrease in value. We're going to do almost none of that inside of this learning module. In fact, what we do in our slide deck and what the Institute does is say something like, you know, there's very little impact of foreign currency on all of our pro forma expectations. What we need to do is we need to look at historical trends. We'll do that here in a second or two on the next couple of slides. And what we need to do is figure out how we can use that historical trend, like growth in revenue, to predict the future. So we must adjust for deviations from history. Because, I mean, look, even if we've had revenue that grew by, let me just pick a number, 3%, 3%, 3%, 3% over the last 4 years, there's no way that in this current upcoming year, their revenues are going to grow by 3%. I mean, that's just the nature of the dynamics of the price markets and the quantity markets. Yeah, look down at the bottom. Revenue changes due to volume or the price mix are considered organic growth. Now, we'll have a separate line item on organic growth. Remember this term? I never heard this term when I was in college. Remember, I went to college 100 years ago. This term organic really just grew in the last couple of decades, at least as it has relates to the stuff that I study and that I teach. Organic means just self-growth, internal growth. What's the natural growth rate of let's say vodka or gin, because some individuals may buy 1 bottle a month. And over time, maybe they'll buy 1 bottle every 3 weeks. And that's kind of organic growth. Notice at the bottom, this is separate from acquisitions or divestitures or foreign exchange or growth because we issued a bond or any of those kinds of things. All right, so let's not be too intimidated by this. Here is the spirit and liqueur segment. So we have several years of historical information. So there are revenues 2018, 17, 20, all the way to 2022, 1650. So notice that's a decline. So over the last 5 years, we've declined by, well, you can see the year-over-year growth. There's a 0.6, there's a minus 0.6, minus 0.6, minus 1.2, minus 1.8. But then notice, for some reason, look down at the bottom, we anticipate 7% and 6% in year 2023 and 2024. Now, the Institute is probably going to give you that. In fact, I hate to use the word guarantee. You guys have heard me say this before. But it seems to me like the Institute is going to have to say something like, here's the historical growth rate. Here's what we expect in the future. So we've had poor growth. Actually, we've had negative growth over the last 5 years. But for some reason, we're expecting much more massive growth in 2023 and 2024. So let's just step back and say, you know what, this is going to be given to us in the problem. But if we were forced to answer this question, maybe we would say something like, hey, here we have, historically over these 5 years, we have 2 brands of gin. We have our regular old gin, and then we have a lime-flavored gin. But in 2023, we're going to go ahead and introduce something else, some kind of, how about strawberry-flavored gin? I mean, I love a gin and tonic. I'm not sure I'd like a strawberry-flavored gin. But anyway, there might be some reason to increase that to 7 and to 6%. There's the volume sales. Notice that there's some positive numbers and negative numbers, and so we're going to assume just 6%. There's our price. So the price has risen, the price has fallen, and we're going to expect that 4%. There's organic growth. We're expecting, what does that say, 10.2, 10.2. And this is what I was saying just a moment ago. We have had some foreign exchange impact, but we're not going to have any impact here going forward. Now, this is a great question. It might be because in 2018, 2019, and 2020, Diego didn't use any forward contracts or futures contracts or option contracts to hedge our foreign currency risk. Maybe now in 2023, we've learned our lesson and we're going to use forward contract every time, which would mean that there would be no impact. Yeah, a couple of other things about that organic growth. There's the calculation down at the bottom, 6% volume, 4% price mix. So we're not going to add the 6 and the 4. This is a really good exam question. And this just goes back to our discussion on the rate of inflation. Remember, we had nominal rate, we had the real rate, and then we had the rate of inflation. So we use those things, the compounding effects, the 1 plus. So that's what we did down at the bottom there. So there's the organic growth rates. Let's go ahead and use some of the information from the previous slides with some additional information here. Let me just remind you, the Institute is probably going to give you a bunch of these things. But let's go over from 2018 all the way over to 2022. This is the combination of both segments. So let me go back here. We only have the spirit and the liqueurs. We don't have the beer and wine. So in that sales row, that is a combination of both of those segments. And then for the estimate for 2023 and 2024, note up at the top, we have this generated using Excel. So that growth in sales is, there's probably some rounding in there as well. That's probably around 7% and 6%. Cost of sales, that's going to be given. That went up by, what was that, 6% earlier? So the gross profit, let's just go out to the estimate column. So you have 2262 minus the 785. That gives you 1477. If you take 1477 over the 2262, you should get 65.3. So there's one question that you ought to be able to know. Feel free to pause the video and do calculate some of those other years so that you know how to compute that gross margin. I'm not quite sure the Institute would ask you to calculate the change in the gross margin. But I guess what this does is gives us some insight, even though you can kind of look at it, but that change in gross margin, that's in percent form. So it goes down a little bit, then it goes up a little bit for our estimate. So that, I'm not sure there's a whole lot of information there. Distribution costs, those will probably be given. Just put that in the numerator. Divide those by sales to get that row of distribution costs as a percent of sales. Same thing in administrative expenses. That ought to be given. Administrative expenses as a percent of sales. Same thing with other operating income. So we work our way all the way down to EBIT. Remember, that's essentially operating income or income from operations. Take those numbers and divide by the top line up there in sales or revenue, and you ought to be able to calculate those 33%. So let me give you some advice for the exam. Make sure you can compute the 22, let's start over here in the 2023 column. Make sure you can compute the 65.3%, the 21.7%, the 9.9%, and the 33.4%. On the other hand, what if the Institute says, hey, the distribution cost as a percent of sales is 21.7%, then use that number to get the 492, and then you should be able to compute this entire column. Remember, the Institute's probably not going to give you 100 columns out there and ask you to compute 100 of these things. They're just going to ask you just one of those questions. All right, so a couple of slides here that just summarize what we've talked about in that previous slide on that pro forma statement. Forecasting is done on a percent of sales. So that's what we did back here. And this is why I was explaining it to you. You could do it the one way or you could do it the other way. In the Diego case, that gross margin relatively stable, somewhere around 65%. But notice the orange diamond point. We project the gross margin to increase by 100 basis points each year over the next 3 years. And this is driven by rising total revenues. So think about what's happening there. What we would like to do is we would like to sell our bottle of gin for a little bit more and sell 1 or 2 more bottles a week or a month, right? So there's that rise, the total revenues from the price mix. Now, of course, what we're going to have to do, and the Institute's very big on reviewing and monitoring, if that revenue growth either is above or below our expectations, we're going to have to go ahead and adjust these accordingly. That makes perfect sense. All right, how about the selling, general, and administrative expenses? I'm not sure there's very many exciting things to say about this. Notice down at the bottom, we expect modest increase as a percent of revenue of 20 basis points annually. How about the administrative costs? They're risen from 9 to 10%. Look at the bottom there. We predict 1% annual growth in administrative costs. I don't think these things are too interesting or too testable, but I'll just go back to this thing right here. If you can calculate every one of those accounts in the column, then you ought to be able to work through any kind of a different kind of a question. All right, how about this pro forma EBIT forecast, segment forecasting? Here's a quote. We disclose current operating profit for each of its segments along with operating costs at the corporate or holding company level. Okay, down at the bottom, there's a little formula for the sum of the segment current operating profit. All right, so let's take a look at the combination of the two. Let's take a look at the D combination. Let's segment them, the spirits and then the beer and wine for all of those years. So there is the 2262, the 2394 that we saw in the previous slide. And then we're going to decompose this into the profit for each segment. And let's go to 2023. There's 489, there's 66. And there are some corporate level costs are being reduced by 25. So there's current operating profit of 530 expected in 2023 and 560 in 2024. Notice that the Institute's probably going to have to give you much of this information, maybe ask you to sum down at the bottom, which then allows you to compute all of these kinds of ratios here. So I'm going to go ahead and just have you pause the video and just toggle back and forth here. You should be able to compute, well, look at the bottom, it's about 23%, give or take a couple of basis points each year over that time period, including 2023 and 2024. All right, so why are we forecasting higher revenue growth, partially driven by that strong price mix growth? The benefit to the gross margin is going to be offset by those higher distribution costs. What did we see back there? 27.7%. Not expected to see much upside. Margins to increase modestly for the beer and wine segment. Overall, we're consolidating that operating margin 23.1 to 23.4. That's fairly modest, I would say. Now let's move on to other than operating expenses. So number 4 here, let's focus on the interest expense forecast. So of course, to estimate interest expense, we need to know essentially the total amount of the debt and then the coupon rate on those debt instruments. Long-term debt, short-term debt. So there you go. 2023, 480 for long, 95 for short. There's the total debt. There's our interest expense. There's an interest rate, 1.7%. So interest expense is 10. We're gaining 0.1. That's millions of Great British pounds, right? And so our net financing cost is 9.9. Notice, net interest expense on the debt minus the interest income. So that's what we did there. The 10 minus the 0.1. That 10 was a function of the coupon rate on the bond, which we weren't given here in the problem. That 0.1 is a function of the interest rate on our cash or whatever those marketable securities that we have. How are we going to anticipate or forecast the interest expense? Well, this is not too terribly difficult. We're just going to go back and say, here's the amount of debt, and here's our investments. Multiply them by the appropriate interest rate, and you get whatever that number is down at the bottom. Oh, yeah, look at this sentence down here. For companies with higher yielding assets, interest income should be forecasted in the same way as interest expense. Okay, that makes sense. All right, how about corporate tax forecasting? Hey, feel free to fall asleep if you'd like to here. Corporate tax forecasting, this just doesn't sound like it's very exciting. I hope I didn't offend all of you accountants out there, but here we're told that wherever we are in the UK, 30% is the effective tax rate. So we go back to that row of EBITs, right? Earnings before interest and taxes. So there's the tax rate. So you should be able to compute the 220 all the way out to the 226 and the 241. Feel free to pause the video if you need to. Well, now we need to worry about what is going to be that earnings per share. What is going to influence the changes in the earnings per share? Well, we did the numerator, right? We calculated the earnings up at the top, but now we need to compute the denominator of what are the outstanding shares. So if the company has no warrants, has no stock options, has not issued any shares of stock, doesn't have any of that other stuff that it's paying its executives, well, then the basic shares outstanding and the diluted shares outstanding, they're going to be the same number, right? That should be super obvious. But we'll probably have some of those things in there. So look down at the bottom. The tables below show the information on the shares outstanding. So here we go. We start with 48.6. We end in 2022 with 49.8. So we're expecting 50.2 and 50.9. That is because, so we're not doing any share repurchases over the next 2 years, but we're going to issue some shares, 0.5 and 0.5. So that makes sense. We go up a little bit, ending basic shares outstanding. There's the weighted average. Remember from one of those earlier learning modules, to get that weighted average basic shares, we needed to take the beginning and the ending, take the average of the two, and that's what we get, that 50.5 and the 51.2. Notice that we have about a little more than 2.5 million of those dilutive securities, which could be the options. They could be it could be convertible bonds to common shares. Could be anything out there. And then we get the weighted average diluted shares. What that enables us to do is to go ahead and compute, some extra piece of information. So what does this slide tell us? So we're gonna increase our outstanding shares. There it is, 2.6 million. The management does not actively repurchase shares, does not offer substantial share-based compensation. So this ought to be a minimal amount. So what we can do then is we can put this together and form all of these accounts that go to the bottom of what we've done from before. So let's go out to the purple, 2023, start with the sales, work our way down, just like we did before. Administrative expenses, there's that 9.9%. There's the 5. So we get the EBIT of 755. Now we can start doing some extra stuff. There's 33.4%. We calculated that before. Now we have depreciation and amortization. Remember, these are non-cash expenses. That's why over in the left-hand column we have the words add back. Take that as a percent of sales. You get the 1.6. So there's earnings before interest and taxes and depreciation. There's the margin. So now we can do the net financing cost. There's the 9 from before. Other financial expenses, that's down to 0. Here's our profit before tax. There's the income tax, effective tax rate. Do you need me to go all the way down there? So net profits of 522, and there's a year-over-year percentage change. Oh boy, let's just keep going. There's our EPS, there's our basic, there's our diluted. And so down here at the bottom, what we can do is, we already hit the bottom up there. So this is what we're doing, the 10.42, there's our earnings per share, and then there's 9.92, there's our earnings per share that is diluted. And then we can do the basic, and then we can do the average number down at the bottom, which we did in a previous slide. So here, let me just scroll back and forth here. Notice this was 4 slides. So the Institute they can't even fit all this on a piece of paper or one question stem. So my advice is to pause the video and just go through this. Make sure you can calculate each one of these percentage. Make sure you can do the math. And my advice is to do it for the 2023 purple column, because if you can do that column, you can do the rest. And so this is what we've done. We've put together this pro forma company model. It's a sales-based model. Now, a couple of things here before we move on. I'm not quite sure why the Institute tells us earnings before interest and taxes, depreciation, and amortization is not typically presented on the face of the income statement. Now, we know that's an important number, but firms just don't typically report it. So we know that from our previous learning modules. All you got to do, if it's not shown to you in a question stem, just add back depreciation and amortization from the statement of cash flows to EBIT. Let's move from the pro forma income statement to the pro forma statement of cash flows, which from my perspective is way more interesting. Not sure if it's more testable, but at least from my perspective, it's way more interesting. So look down at the bottom of this slide. Of course, I'm guessing you remember that we've got operating activities, investing activities, and financing activities, and we're going to be responsible for putting together cash flows from those three areas. So if you look at the top teardrop point, we're going to have to estimate expenditures, depreciation, all those things listed there in those bullet points. Now, just like we did back in the income statement, there will be much of what shows up in these next few tables has to be given to you, and there'll be some elements that we'll have to calculate, and I'll remind you of those as we go through this. All right, so back to the Diego case. There in 2021, we've got a 5% increase, a 5% of capital expenditures as revenue. There you see that in that, what is that, dark blue, or is that black or navy? You see that 5%. So if we go from the top all the way down to the bottom, the depreciation and amortization, that was given to us in a previous table. You can go ahead and compute those percentages. Then capital expenditures, property, plant, and equipment, and intangibles. This is a new row that we haven't been given. And since that 40, 50, 60 is not broken into each of those, that next row of capital expenditures as a percent of sales, that's also given along with the ratio. A couple of other things to note in that table and some subsequent tables. We're going to look at some positive volume growth. That's going to be 5.2%. Let's go back here real quick. So look at 2021, there's 5%. Then we're going to assume that we've got so we grew at 5.2 in 2022. We're going to assume that same growth rate in our estimates for 2023 and 2024. What that probably means is that we're going to increase our property, plant, and equipment, which means we'll have some increase in depreciation. So we're going to make the assumption that that's 4%, and that's based on an average. Here is a table of working capital, which we haven't seen to this detail yet. So all of these accounts, these are new rows, so these will be given to you. I'm guessing the more important row is that change in working capital from the minuses in the late teens to the pluses, especially for those estimates. I'm guessing the Institute would be more likely to go ahead and ask you what that change in working capital means, in addition to what are the implications for that change, and also the days that we have in those final three rows down at the bottom. But you're all over this because we've had great conversations about ratio analysis before. A couple of things that are interesting. The largest working capital component is inventory. And that net working capital, well, there's a 91%. So let me go back to 2022. There's that 91%. A couple of other interesting things. 1,500 days of inventory on hand. I think it's fascinating that the Institute is including COVID in some of its conversations. We do the same thing here. Projected to decline to 1,200 days. That makes perfect sense. Day sales outstanding remain stable, and the payable outstanding is going to fall to 588 days. Some assumptions that we're making about total outstanding shares. We need to worry about share-based compensation, which of course includes things like stock options and other things. Dividend paid, we're assuming that they're going to be the same in our estimates, 2023 and 2024, as they were in 2022. Share-based compensation, no share repurchases or issuance. So that makes life fairly simple for us. So let's go ahead and start with the top line of our projected cash flow statement. There's the net income that we've had from a previous slide. And by the way, let me just remind you, I said this to you before, feel free to pause the video and go back and scroll through the slide deck so you can actually see those numbers, where we got them from, and then how we calculated these things. So there's depreciation and amortization. That's also from a previous slide. So now we have a couple of items that we didn't know from before: share-based compensation, other non-cash items, and then in between those is our investment in working capital, which we did just on that previous slide. So and let's just look at 2018 there. That's the easiest column on the left. Let's just sum those numbers. You get 553. Notice we have that bolded. So that's probably a potential good exam question. The Institute may give you a couple of different tables. Just add those together to get cash flow from operations. Remember, you always start with net income, and then you add back those non-cash expenses. Then we have other investing activities. Oh, there we go. There's the CapEx. So there we go, 40, 50, 60. We had that from before. There's other investing activities. So there's the cash flow from investments. Let me just go back here. So we've got the 40, and you add the 2, and that gives you the 38. How about cash flows from financing? We didn't have any debt issuance in 2018. We repurchased 27, dividends paid. So you have that, you get 52. And then foreign exchange translation, there's a new row. Change in cash, which we've had before. And there we go, our cash equivalents. That's 549. So let me just go back here quick. This is my takeaway. And this is what I think is the most important questions that you could be asked. Make sure you can do cash flow from operations, from investments, from financing, and then you can go from the beginning cash to the end of cash. So there we go, from 549 all the way out to 1259 in 2024. Moving from the income statement and the cash flow statement, it makes sense then to go ahead and project the balance sheet in its pro forma sense. Notice what we have in that first diamond point, the historical starting balance sheet. That's probably what we'll start at. But look at, for simplicity, we're going to say something that a bunch of these accounts, they're just go ahead and they are consolidated. And the stockholders' equity, you know this from a previous learning module down in the purple. We'll just take old stockholders' equity, we'll add the net income and any share-based compensation, and then take out dividends. So what does that leave us for the balance sheet? Oh boy, we have some of these numbers that we've seen from before. So I think the challenge here is to go from the income statement and the cash flow statement and extract those important values and then put them here on the balance sheet. But again, remember that the very first thing that we did inside of financial statement analysis was take a look at the balance sheet. So you know you're going to have these accounts. So you get 1945 in 2018 current assets, and 752 and 20. So we didn't have those before, right? non-current assets. So if you keep going down, we had some debt in a previous slide. Accounts payable, that was in a previous slide. So you get the total current liabilities. So boy, is this a really good question? I don't know. If the Institute would do this for you, ask you to do all this stuff, and then say, oh, by the way, calculate a current ratio, in which case you would just do the 1945, I'm in year 2018, 1945 divided by the 616. And then you can take a look at those, quick non-current liabilities and total equity, and you get the 2903 for the year 2018. So my advice, once again, as it was with the income statement, with the statement of cash flows and the balance sheet, pause the video, take a deep breath, go back, make sure that you can compute all of the accounts that we have bolded. Now, we did all of that work so that we can do some other work. Recall that among the most important decisions that executives can make is the capital budgeting decision. In order to make capital budgeting decisions, we need to compute net present value or internal rate of return. In order to compute those two outputs, we need some measure of cash flow. Now, what we did 2 statements ago, we did the statement of changes in cash flow. Remember, we had the 3 different kinds of activities, but now what we're going to do is we're going to go ahead and kind of throw those all into the same bucket, and we want to get free cash flow. So look down at the bottom, free cash flow to the firm. We did this in a previous learning module. So all we're going to do is we're going to start with our EBIT. We did that, was that 20 slides ago or so? There's a tax rate of 30%. There's our depreciation and amortization, change in working capital, capital expenditures. So there you go, free cash flow to the firm. So we computed it, 441, 528 historically, but then this is super important. As we're going to try to make these capital budgeting decisions, we want to know what free cash flow to the firm is in 2023 and 2024, based on all of the hard work that we just did in those pro forma financial statements. So once again, I would know the income statement, the balance sheet, the statement of cash flows, be able to put those in that pro forma format. And then this one here, I can't imagine the Institute wouldn't ask you free cash flow to the firm, either as it's contained inside of this learning module or what we've done inside of other learning modules. So this is important for now and for other areas. What the Institute does after all of that math and all of those financial statements, and granted, there's a lot of them inside of this learning module, the Institute says, you know what, back when Jim was going through the program, what we did is that we had a separate study session on behavioral issues. But now what we've done is that we have incorporated those behavioral issues into certain learning modules. So the issue here now is, from a behavioral perspective, what are some cognitive errors and emotional biases? You see me do this all the time, just so I can emphasize it to you, is what happens if we're trying to make a forecast based on all the work that we just did over the last, 30 or 35 slides. So that's the first part of the LOS. What are those factors? And here we go. We've got 2, we've got another one, we've got 2 more, and then we'll move on to Porter's 5 forces. So my advice is to have a separate little notebook. You've heard me say this before. And somewhere in this separate little notebook, you have the heading behavioral issues. And then go ahead and under behavioral issues, list these 5 under financial statement analysis. So you'll be prepared to look for these answers inside of this particular learning module. So overconfidence. In fact, it's ironic. I just gave my investment students a lecture on behavioral finance just in the last two classes. So the example I gave them in overconfidence, this is really a cool example. There were some professors who several years ago conducted a survey, and they interviewed as many of the Fortune 500 companies as they possibly could. So what they did is they said to these executives, look, you guys go to these conferences together. Maybe you went to the same college. Maybe you belong to the same country club. But chief executives, they pretty much know each other. Not on an intimate basis or a friendly basis, but they're acquainted with each other. So the question was, I want you to rank where you believe you stand in relation to all of the other CEOs that are out there. And the average self-rank was 95%. That sounds like overconfidence to me. So unwarranted faith in their abilities, which means that as good financial analysts, if we've done the pro forma income, balance sheet, and statement of cash flows, if we've done this 1,000 times, we're probably very confident in our abilities, and we might overlook something that has changed when we're making these new forecasts. So overconfidence, unwarranted faith in their abilities. So don't look for the term overconfidence, of course, in the question stem. Look for something that sounds like unwarranted faith. So that's the first part of the LOS. And then how are we going to remedially resolve this issue? Record, the Institute is very big on record keeping. We have almost a whole learning module on keeping records back in the professional standards. Keep a record, share their forecasts, make sure you review them so that you can identify and correct some of those errors. So the Institute is very big on, all right, this is the decision we make, and let's see how it pans out. And then we go back and see exactly where we erred. Because remember, whenever you make some kind of an estimate, you're going to do it with a degree of error. Representative bias. This is a scenario under which an analyst makes decisions based on a representativeness, representation, or represent. What do we have here? Known classifications or past experiences. So we might think that a company is a growth stock. It's been a growth stock for 100 years. We think it's going to be a growth stock for 100 years. So what we just do is base our forecast on the simple fact that it's going to continue to be a growth stock, even when it might not be. There might be some information that we reject. There might be some information that we ignore. There might be some information that we discount. All those things are involved in this representativeness bias. Confirmation, you know about this, that we always like to hear people say, hey, you know what, Jim, maybe you are the world's greatest professor. And I'm like, hey, let's talk about that for a long time. I don't want to hear any of my colleagues coming up to me and say, you know what, Jim, I heard your students, they tell me that you stink. I don't want to hear that. So what do? Confirmation bias. We read Wall Street Journal articles that confirm what our research has already led us to make a conclusion. We don't want to listen to any kind of a contra thought process about our research. So we confirm this. So how do we resolve this issue? Well, we go out and we ask people. I'll go out to students and I'll say, hey, what did you think of my class? Now that you've taken my class and you've already gotten the grade, what do you think about it? Give it to me straight. Do I stink or am I the world's greatest professor? So what does the Institute ask us to do? Seek perspectives from colleagues who are not psychologically or economically invested. Yeah, that makes sense. Illusion of control. This is a scenario under which we think as an analyst, we think we might have control. And this is, let me go back here real quick. This is a little bit related to overconfidence. So don't think that these behavioral issues are all independent from each other. There's clearly some overlap. And I'm guessing what the Institute would do, at least this is what I would do, although I don't ever ask multiple choice questions in my exams, but I would never have a choice of overconfidence and a choice of illusion of control unless there was something specific inside of that question stem. The classic example of illusion of control is that let's suppose that we're on the board of a company And what we do is we go to these board meetings. So we think that we're in control, and we are, but we probably think we're in maybe even more control than we actually are because we're in these meetings. So then we go home and we buy lots and lots of shares of that particular stock because we're there. The way to get around this is to make certain that when we put together our model, that those input variables are reasonable, they're accurate, they're impactful. Let's go back to another learning module on factor analysis and identifying factors. We'll start with the capital asset pricing model. That's a one-factor model. Then we can go to the Forma and French model, which has a couple more variables, and we can add some more factors in there. So most impactful or most important. Conservatism bias. This is not really the term that relates to like conservatives and liberals politically, so don't make that analogy. But this is related to what we talked about with confirmation bias back here. Conservatism bias is a scenario under which we regularly discount new information because it might conflict with ours. So back, you see the difference? Back with confirmation bias, we just talk to people who agree with us. Here, with the conservatism bias, we may talk to some people who don't agree with us, but we discount it completely. So how do we get rid of this? Regular review models and forecasts. That makes sense. Let's move on to the next LOS, which is a discussion on the Porter's 5 forces. Not that this is important to you, but this is a Harvard Business Review article from 1979. And Michael Porter's goal was to analyze the strength and the weaknesses of an industry. And so he came up with these 5 forces. These appear in various places throughout the CFA program. So it's probably a good idea to remember these. Surely you can remember threat of substitutes, competition, bargaining power of suppliers and buyers, and then the threat of new entrants. Let's go ahead and work through just a quick example. And it's been a while since I've asked you to do this, but I'm going to ask you to get your phone out and take a picture of this slide here in just a second, because I think it's a really, really good slide and it will help you answer this question on the exam. Now, clearly there's not going to be 5 questions on Porter's 5 forces, but there's probably going to be 1. And this is a good example here. Here we've got Tesla, which has been in the news for a long, long time, and it'll probably remain in the news for a long, long time. Let's see. You guys probably know a lot of this stuff. Various markets, United States and China, competitive position, rapidly growing. In the Chinese markets more favorably than in the mature and competitive U.S. market. Although I will comment, this is an editorial here, that if presidents and Congress continue to give such huge tax breaks in the United States, that maybe it'll become, maybe the U.S. market will become a higher growth for Tesla. Who knows? EV market is booming in China. Prominent players. Let's see, 2022, Tesla estimated 15% market share. 20% BYD, other manufacturers held about 25%. So think about this, the main players, 15, 20, and a couple with that aggregate to 25%. So what's that? That adds to about 60% of the market. Let's see, strong brand presence. Of course, we know Tesla's a brand name product line, technology, right? Extensive charging network, competitive edge. Reported some profitability of nearly 23%. Industry participants in China, technological innovation, expanding charging infrastructure. Yeah, that makes perfect sense that, if you can't charge your car, then I don't think you can drive it. Chinese government support for EVs and growing consumer shift towards sustainable transportation presents promising outlook for Tesla. So here's a super simple question here. Which of the five forces has the highest degree of presence in the Chinese EV market? What makes more sense? Threat of new entrants. What did we say back here? Well, we've got the 15 and the 20 and the 25. I don't know about that. Threat of substitutes. Well, kind of the same thought. So the answer there, bargaining power of buyers. So this is what I want you to take a picture of. There's the bolded correct answer. And this is based on, what comes out of the learning module. So I'm guessing that the Institute could ask you about each of these and ask you to say medium, low, or high. What did we ask here? We asked which one has the highest degree of presence. But the Institute could ask, hey, which one's medium, which one's low, which et cetera, et cetera. And then there's some good factors to consider over on the right-hand side. And there in bold, we talked a little, at least in brief, about some of those issues. Take the picture and let's move on with our life. So now we move to a portion of the learning module which deals with both inflation and the opposite of inflation, deflation. So what we're going to do on these next bunches of slides is we're going to take a look at the inflation impact on industry sales and costs, and then company sales and costs, and then deflation on those same things. So I want to give you a little bit of a heads up. I'm going to try to go through these relatively quickly because we've been going in this learning module for quite some time. And so just think about it. Inflation, this is probably good. I don't want to use that word. It's beneficial for revenues because, remember, revenues are P times Q. So if there's inflation, that might mean that the price of our good is increasing. Now, of course, what we have to worry about is if the price is increasing enough, what is the elasticity of demand for that product line? Does the quantity demanded slowly fall with the rise in price, or does it fall slowly, or does it fall dramatically? So there'll be the word elasticity in a couple of these slides. Then on the cost side, if prices are increasing, remember on the left-hand side of the income statement, we have all of these inputs which are a function of the cost of those inputs. Think of commodities. If we're a bakery and we're buying apples because we make apple pie and the price of apples is doubled or tripled, that's going to hit those line items inside of the income statement and our pro forma income statement, and then our cash flow statement and our balance sheet, et cetera, et cetera. Just the opposite occurs, of course, with deflation. So let's go through these slides fairly quickly. If you can remember what I just said, you probably are on top of all of this stuff here. Okay, so the impact of inflation or deflation, it varies among companies. Okay, that makes perfect sense. Cost of inputs, most likely higher prices, we know all that. So here's the deal. If we have inflation, can we transfer those price increases to their customers? Those of you who have been reading the Wall Street Journal during, 2022, 2023, when in the United States our inflation peaked at 9-point-something%, every day in the Wall Street Journal, you would read, oh my gosh, here's a company. They're trying to pass along these costs to their customers. Some customers are buying it. Some customers are not. So that's an important concept. All right, so this is the first part. What did I say to you? We're going to look at industry sales in an inflation scenario. So all of this stuff here is pretty much some extra details of what I described earlier, right? So companies may attempt to pass those costs on to consumers, but sales volume may decline if the demand is price sensitive. So just think, put this in your notes or put this in your head, that first diamond point, that's the P times Q that I was talking about. And there we go. Then very next one, consumers might switch to cheaper alternatives. There's an example there. How about key considerations? Well, there we go. Price elasticity of demand and the ability to pass on costs. How about industry sales in a deflation scenario? So let's just go ahead and flip this upside down. Let's stand on our head. If we have the P times Q, then the P is going down, and this is for the entire industry, right? Then we might have a price war and operational challenges. Of course, we can go back and use that same concept of elasticity of demand. It works both ways. If the price is falling, maybe then we're going to have a higher upward slope in terms of quantity demanded. But one of the things about deflation that is unique as compared to inflation is that we almost always have inflation. There's always 2% or 3%. Sometimes there's 9%. We almost never have a minus 2% inflation or a minus 5% inflation. So that's why that last arrow point down at the bottom is super important for these industry sales. And it's going to be important for our company sales here in just a second, is that we need to go back during periods of declining prices and see exactly what happened to that price elasticity of demand so that we have a better ability to forecast. All right, how about industry costs during an inflation scenario? What did I say earlier? Raw materials, those were commodity, energy, so there's oil and gasoline and labor costs. Now, remember to distinguish between raw materials and energy. Those are one set of inputs, and then we have a different set of inputs that are labor costs. So with labor costs, we have to worry about the bargaining power of our labor supply and the skill set of those laborers. So you think about it, if those laborers have super high skills, then they probably have great bargaining power. But if they don't, then they have less bargaining power. I use my example. When I was in high school, I worked at the local high school over the summers as a janitor. Now, most people call that a custodian, but I scrubbed the floors and cleaned the toilets. I did all that kind of stuff. And it wasn't a very high skill set. I would come home from work and my dad would say, "What did you do today?" And I would say, "Nothing that nobody else in the entire world couldn't have done without me." So I took pride in my work. And that probably has led me to being such a high level of integrity that I feel like I have today. Anyway, what are some other interesting things here? If we're experiencing volatility and especially inflation in those input prices, well then why don't we turn to forward contracts? So this is a great link between what we're talking about inside of this learning module and our derivatives learning modules, because what we can do is we can go ahead and sign a forward contract or a futures contract, or an options contract, or a swap contract for things like sugar and oil and lumber, all those kinds of things. Whatever our inputs are, we can protect ourselves against those inflation scenarios by using these derivative contracts. I'll give you just a quick example. Used to be, I don't know what the current state is now, but it used to be that Southwest Airlines hedged about 75% of its energy costs by using forward and futures contracts. I don't know if they continue to do that now, but it makes perfect sense. I'm always of the assumption of, why not 100%? A couple of other things here. There's that term volatile that I used just a second ago. How do we manage that volatility? So this falls under the umbrella of risk management. So there's a lot of things that we can do in terms of trying to contain those costs, not least of which is the derivative securities contracts that I just described, but also long-term wage contracts with our employees. Look at that bottom one there. Just like our customers can substitute, well, so can we. We can substitute some less costly inputs. The great example here is that, suppose that we're a furniture maker and we're using super prime pine wood from Canada. Well, maybe we'll just pick less than super prime pine wood from Canada. I'm not suggesting that we don't tell our customers that we're using less than pine, but you get the point. All right, so how about industry costs in a deflation scenario? Well, so what's happening here is that our left-hand side of the income statement is falling. The problem that we have, this is all good news, right? I tell you this in a previous learning module. What's the goal of the business? Maximize shareholder wealth. How do we do this? Make something for pennies and sell it for dollars. Well, this sounds like we're in line to make something for pennies. That's a great thing. But of course, the fact that those inputs are in a deflationary environment probably means some other things from an industry standpoint that we might have to be concerned about. What are some of those extra concerns? Well, we've got fixed costs and we've got variable costs. So we're going to try to optimize. We're going to try to reduce waste. We're going to adjust the scale. Remember that we always want to have all of these kinds of efficiencies of scale, efficiencies of scope, all those good things. In the industry, if we have lower input costs, then this might mean going back to those 5 forces, we might have new entrants, because if you can make something cheaper, then somebody else can also make it cheaper, and there'll be extra competition, not only from new entrants, but also from our current competition, in which our current competitors can offer discounts or other kind of cool pricing things that lead you into the store. All right, so I think we did that fairly quickly. I think we can do this one even quicker. So now we're going from the industry, so let's go down to the company. Company sales in the inflation scenario. So here are these factors. Let's go through these relatively quickly because we just talked about these at the industry level. All right, so industry structure, what does that mean? Do we have a monopoly? Probably not. Do we have an oligopoly? Maybe. Do we have perfect competition? That's the industry structure. We did that in another learning module. So if we have lots of competition, we're going to have to focus on product differentiation. We're going to have to be very sensitive to that elasticity of demand. We're going to have to worry about substitutes. And then, of course, the government always comes in. I remember several years ago when for the first time in my life, I actually paid $3.99 for a gallon of gas. I've never paid $4 for a gallon of gas, but this is in 2012 or 2013, somewhere around there. And I remember saying to my family, "There it goes. We're almost hitting the $4 barrier, and we didn't." And so am I going to substitute? Maybe. Am I going to drive less? Maybe. But we've got to be sensitive about the government coming in. And you might remember this. Politicians in the United States said, you know what? These are windfall profits for the oil and gas companies. Let's throw a windfall tax on them. So imagine if you're having lots and lots of sales because of inflation, and then the government comes in and says, you know what? Send those back to us. All right, here's just the blue box of price elasticity of demand. Just remember that if the quantity demanded is very, very sensitive to changes in price, then we have elasticity. If it's not, then we have inelasticity. Now remember from one of our first learning modules, we talked about the board of directors. The board is responsible for a couple of things. One of them is to establish the strategic direction of the company. Now, I'm not saying that this decision here is going to originate at the board, but clearly in board meetings, we're going to talk about pricing strategy and market position. That's why when you look at the boards, there's always an expert in marketing, there's always an expert in efficiency, and there's always some kind of financial analyst on there to give us some kind of extra skill set or extra talent in being able to determine, hey, we've got inflation. Maybe we've got the ability to expand our market. That's a good one right there. And then, of course, the Institute is very big on what happens if we do something in different countries. So not only do we have to worry about, if we're a U.S. company, inflation inside of our borders, but if we're trading with Canada or Mexico or China or Iceland or Santa Claus at the North Pole, then we need to worry about inflation rates. That's why we have this entire learning module on things like purchasing power parity and interest rate parity. Because remember that if we're doing tons and tons of sales in Iceland, and we're thinking, oh my gosh, I can't wait to transfer those Icelandic kronas back to the United States. Suppose we have 100 million Icelandic kronas, and we translate those back to the US, it turns out to be $8. Well, that means that we weren't on top of interest rate parity. A couple of final things here under an inflation scenario. In forecasting sales, we need to think about what that P means. Do we want to lead the industry in pricing, or do we want to say, you know what, you guys figure out the price and we're going to put it at 4% below that? We need to look at the left-hand side of the income statement. What is our cost structure and what is our ability to adjust from an operational standpoint? So a good exam question is down at the bottom. What are those key challenges? Look at the case example there in the middle. A bakery facing rising grain prices. Boy, struggle to pass on costs to consumers because there are lots of bakeries out there. I can buy Jim's Donuts, or I can buy John's Donuts, or I can buy Krispy Kreme or Maple Donuts. There's a lot of substitute products out there. So how do we handle that? Explore operational efficiencies. We talked about that in a few slides ago. How about this one? This is a new one, diversification of product lines. Now, let me be super clear about this. Remember that shareholders can diversify themselves. Right? There's tons and tons of companies out there to invest in that, in this case, are bakers. Well, we don't want to diversify just for the sake of diversification. What we want to do to diversify is to use that diversification model to expand our P times Q. We'll go ahead and take advantage of correlations and covariances and maybe R-squareds if we get into regression analysis. But we don't want to just diversify for its own sake. Now let's go ahead and turn this all upside down. What about company costs in a deflation scenario? So remember what I originally said. This is probably not bad news, at least in isolation. But what we need to do is take a look at the supply chain. This is one of the cool things that we have in our finance trading lab. We have access to the Bloomberg terminals. I'm guessing you guys have access to it. Many of you do. So the next time you're in there, go into the supply chain function. You type in a company, like Microsoft, and you'll see all of the companies over here that supply, and then all the companies over here to which Microsoft supplies. And so what is this? What is the Institute asking us to do? To assess the supply chain, production inefficiencies, contractual obligations. So you can do this inside of the Bloomberg terminal. Now, of course, you won't have access to the Bloomberg terminal on the exam, but you get the sense of how important seeing the flow of those dollars into the company and then out of the company. Actually, it's out of the company and into the company like that. All right, so what are the actions taken? Scrutinize, renegotiate, optimize. Yeah, we did that before. All right, so towards the end of this learning module, the Institute says something like, all right, what we did is what did we do in those early ones? 2023 and 2024, those were our forecasts. So now what we're going to do is say, you know what, let's think like the board thinks. What about 5 years from now? What about? So we need to kind of pick a forecasting horizon, long-term forecasting. So the essential linkage here is to identify what the board and the executive leadership team believes is the expected life cycle of a particular product line, and then we want to forecast it to that and maybe even a year beyond that, right? So from an analyst's perspective, we need to pick out that investment horizon. We need to look at a company and say, you know what, Johnson & Johnson, they've been making artificial hips for, I don't know, well, I've had mine for 13 years or 14 years. So they've probably been making them for 20 years. They're probably going to make them for another 20 years, something like that. But then remember the Institute in many learning modules, we've got that, kind of like the J curve, where you go down for a little bit and then you go up. And that's, there are a lot of different ways to do this, but that's the business cycle or the life cycle of a product line. How long does it take to reach that profitability level? So we're going to link the cyclicality of the industry and of the company to the product life cycle and those estimation of, boy, what did I say was more important back in those forecasts? Those free cash flows. So the Institute says here, and we write this, how do we reach the profitability level? And that's important. But how long does it take for us to reach sustainable operating cash flows? And then what do we do with those cash flows in terms of free cash flows? Company-specific factors. These are major events like a stock split or a massive dividend or a merger or an acquisition. And then what are we going to do over here? We're probably going to use some kind of a discounted cash flow model to compute something like net present value or internal rate of return today. Now, that's not an emphasis inside of this learning module, but that's the next step. In this step here, all we're doing is saying, hey, let's try to forecast free cash flow in 5 years, something like that. Now, a couple of ways that we can do this. We need to introduce the concept of terminal cash flow. And terminal cash flow is really nothing like a future selling price of the company. So how do we estimate terminal cash flow? We can just use multiples based. We can go and say, you know what, we saw that we sold this particular asset at this multiple 5 years ago. Well, depending on growth rates and current state of the company, maybe we can sell it at a multiple of 6 or 7. So historical multiple-based approach. Remember, we talked about tons of multiples in previous learning modules. Discounted cash flow technique. This, of course, is the preferred method. We're going to estimate those cash flows, and then we'll calculate the terminal value based on those things going on for maybe an infinite time period. We need to worry about these inflection points. What are some sources of these inflection points, which are, inflection points in economics are always, you're going along, and all of a sudden, boom, you go down, or boom, you go this way. So it's some dramatic change because of, well, how about if I just give you some quick examples? How about COVID? How about the 2008 financial crisis? How about the stock market crash of 1929, et cetera, et cetera? So here are the examples that the Institute provides us. So look for those kinds of things. Oh boy, that takes us through this very super long learning module. So hey, if you stayed with me the whole time, thank you for your patience. I hope it pays off. So what I want you to do now is go to the end of the learning module, and you'll be completely surprised. You should expect hundreds of questions, but there's not. And in fact, of the number of questions that are on there, I think there are only 4 that you're going to have to use your calculator. So anyway, thanks for watching. Good luck studying. Have a great day.